There were some big moves in the real estate landscape this week, including David Eby announcing sweeping zoning legislation that affects the entire province. And it essentially allows multifamily units to be built on any single family lot. On top of that, and in the face of record high immigration, the immigration minister this week announced that they are maintaining their increasing targets for at least the next 3 years. Down south in the US, the Fed held rates, which we're going to talk about. Meanwhile, back in Canada, we have a fresh new GDP update. And lastly, the October real estate stats are out. So we are going to get into all of it, lots to discuss, and all these things are directly going to affect real estate in Vancouver and across Canada. And real quick, before we get into the details, for all the realtors on this call right now, well, Ryan and I, we run a successful team of agents here in Vancouver called the Vancouver Life Real Estate Group.
And the big news is we're looking to add realtors to our team.
So any agent that join us, well, they're going to have access to the same systems, leads, coaching, and accountability that has made our existing team so successful.
So if you know a realtor who would benefit from being on a top producing team, have them go to thevancouverlife.com/join to connect with us today.
Okay, perfect. Now let's get into what is important in real estate this week. Off the top, we want to discuss the immigration targets. Immigration has understandably radically affected not only rental rates across Canada, which are currently at all-time highs, but also the housing crisis is being further exemplified across ownership as well, where we're seeing prices not peeling off in an environment where most people definitely expected them to. So this week, the federal government announced that they are going to maintain their target of 485,000 permanent residents for 2024, and that will increase to 500,000 for the years 2025. And then in 2026, they're going to stabilize, meaning they're going to maintain that 500,000 per year estimate or target rather for immigration. Now, keep in mind, these are targets, and the actual numbers that we've been seeing for at least the last 2 years have obviously been breaking these targets way, way above and hitting all-time highs for basically every quarter that the data comes out. And let's also remember that this is not reflecting the international student numbers too, which right now is basically a free-for-all. So there's no cap on international students coming into the country as well. And understandably, everybody that we're talking about here needs housing in one form or another. So you can expect the rental market at a minimum to maintain the current all-time high rates and likely get pushed even higher, as there is no way to add new housing at the rate of these immigration targets over the next 3 years.
That's right. And when you consider how to get everybody into affordable housing, you've got to look to really big announcements and really big changes across, sweeping changes across that add to reform. Some of that, we're hearing some of that here from David Eby, who announced a new provincial legislation this week. The proposed legislation is province-wide and will permit one secondary suite or one laneway home, an ancillary building, in all communities throughout BC. So this supersedes the Plex plan, for example, and municipalities of more than 5,000 people. These changes will also require bylaws for 3 to 4 units permitted on lots currently zoned for single-family duplex, and 6 units permitted on larger lots currently zoned for single-family or duplex use, close to transit stops with frequent service. When you look at this, the preliminary analysis indicates the province could see upwards of 130,000 new homes over the course of the next 10 years. That is assuming that trades can handle that level of volume, and expect this legislation to take somewhere between 2 years to roll out.
So a big change, of course, and there will understandably be pushback because like any legislation, this has not been fully thought out or fully detailed. We'll stay on top of it and keep reporting it. But as of right now, it is definitely one way to help with the housing crisis is by automatically rezoning everything, because the time and the money saved there is currently very, very cost and time prohibitive. So Overall, I think it's a great idea. Obviously, we're going to hear lots of horror stories along the way. Can't imagine a sixplex popping up in Shaughnessy anytime soon. But either way, this is a overarching plan in the right direction. So I think we're pro this, and we'll see how it all pans out over the next couple of years here. So quick look down to the States, where the US Fed, they did hold rates this week on Wednesday. Currently, their rate is 5.5%. And it's been there since July of this year. And why? Why did they hold? Well, similar to Canada, they were citing the slowing economy and a really tight credit market. So all the hikes that they've done, the 11 hikes they've done, have or are still working their way through the system. Right now, if you're in the States and you want to get a mortgage, they do 30-year terms there. And a 30-year term average is 7.8% for your mortgage rate. So obviously very high. It's a 20-year high. And subsequently, we've got a 20-year low in new mortgages there. So their housing market is slow as well. Feels just like Canada's from what we can tell here. They did in their remarks leave it open to future hikes, as they always do, as they have to. But realistically, the landscape for the overnight interest rate in the States is very similar to Canada, essentially being stable. And what else has been kind of stable, if you will, is the GDP print. We just had another one come here in Canada, and it was flat in August, and September looks to be flat as well. And this is, of course, including the rapid population growth. So realistically, if we take like the not adjusted for population GDP, it's been essentially unchanged dating back to February. Looking forward then, the annualized third quarter GDP is actually expected to contract by about 0.1%, followed by a 0.2% contraction later in the next quarter. So that would technically imply that Canada is already in a recession, albeit a shallow one. Though, of course, if we look to GDP on a per capita basis, we've already been negative for a couple quarters now. So when you look to that data and you look to it being similar in the States, realistically, I think we're going to see rate holds be the predominant story for at least the next 4 to 6 months.
Yeah, and again, pay attention to how those numbers get revised later into the year as well, because it's possible as this continues to come out that the numbers actually get contracted even further. We'll see though. Looking at the Canada 5-year bond right now, after hitting 4.4% range in mid-October, yields have been steadily dropping since October 19th. They're now sitting around 3.9%. That's a 10% drop in 2 weeks. And it's very much expected that fixed mortgage rates will follow suit here as well.
So a little bit of relief in that space, which is obviously welcome to any home buyers out there or prospective home buyers. And let's talk about home buyers, because what happened in October? We do have the October real estate stats and data out here for GVRD. And as always, we start off with sales. How is the volume of sales out there? Well, there's no question it's slow. They almost cracked 2,000 units sold in the month of October. It's like 1,996. This is actually an increase from where we were last year by about 3.5%. And it's also up 3.5% from last month. But we are well below the 10-year seasonal averages, to the tune of about 30% below that. So anybody out there buying or selling, you can definitely tell that things are essentially moving at a snail's pace. They're slow now, and I honestly think they're going to slow further. I mean, we are going into the winter seasons here, being in November already. And for relation here, we look to what's happening in Toronto. Well, they're feeling it even more so, the slowdown that is. When we look to how many months of data we have where there were less than 5,000 homes sold in the GTA over the last 20 years, well, it was, of course, the financial crisis between November 08 up to February 09, April, May of 2020, when it was COVID shutdowns and you couldn't even leave your house, and last month. So again, we always reference COVID. We always reference the GFC to the numbers we're seeing today. So it's equating to around that time. Why? Well, of course, the comparatively high mortgage rates that we're experiencing right now are definitely keeping buyers sidelined. Just like the States, we're seeing about a 20-year low in new mortgage growth. So expect sales moving forward. They're going to sit around where they are now, that 25%-ish below the long-term averages for at least probably now until January, and we'll see what happens come February. But slow for the next 3-4 months for sure.
Yeah, and I would venture to say that sentiment is right down there with it as well. So with that being said, let's look at new listings here. New listings in the region totaled 4,664 properties that were for sale in October. That's a 15.4% increase compared to October last year, and a 17% decrease month over month, lending to a 4.8%, sitting at 4.8% above the 10-year seasonal average. So new listings popping up, helping to somewhat soften price. But again, with buyers just sitting on the sidelines and affordability being the main issue here, it's possible we'll see this continue to rise. But at the same time, I think, much like Dan just said, new listings will also, they will not come out at the pace they've been coming out in the following 3 months here as we enter the winter season.
Yeah, so even with above long-term average new listings coming out, inventory is still struggling. Like it is increasing, but just not at a very exciting pace. Like it averaged out, or it ended up here at the end of the month at about 10,900 listings, which actually dropped from September. It dropped about 1%. It is slightly higher year over year, like 3%. And as we mentioned earlier, it actually crossed a 12,000 threshold earlier in the month. But of course, what happens is a lot of properties are delisted at the end of the month, and people are like, well, it's a slow market. It's November. It's going to slow down more. Let's not even relist. Let's wait till the spring market. So realistically, I think inventory wise, we've basically peaked for this fall market, which doesn't even really exist, but we've kind of peaked here. I don't expect to see this rise much more, especially going into November and December. Historically is very slow, and all the economic factors are pointing to a very slow December this year as well. So for those out there looking, pretty slim pickings and likely to get even slimmer. But of course, for those that are looking for the good ones, you just have to act fast, which we're going to get into shortly here.
Yeah, the sales to active ratio is putting us in a balanced marketplace. It hasn't really changed too much from last month. We're sitting at 17.9%. That's up 0.2%, so a nominal difference month over month. This is the second month of a balanced marketplace. So buyers, if you're listening to this and you are looking for a home, now's the time to be negotiating, right? When we look at it based on asset class here, so you look at detached homes, typically the market leader, we are sitting at 12.9%. That is hovering on a buyer's market, right? Less than 1% down, and we're in a buyer's market here. So looking at that though, that is up 0.3% from the last month. Townhomes are sitting at 20.9%. So still just inside a seller's market here. That is down though 0.7%, so trending downwards. And apartments sitting the highest at 21.5%, up 0.2%. So the month over month changes here are essentially flat. This is also a great indication in terms of what buyers and sellers are experiencing in terms of sentiment in the marketplace.
So how is this all affecting price? Well, when we look to the HPI, it's down now for the third month in a row, where the average HPI price sits at $1,196,500. That's down about 0.5% month over month. But when we scale back and we actually look at the year over year, HPI is still up. We're up about 4.5% from this time last year. Right now, we're back to about June of 2023 prices. Looking at the other two metrics here, median prices actually rose again this month. It's been 2 months of increases. It went up about 3,000 last month, currently sitting at 970,000. For reference, it peaked at 1 million, so we're off 3% on the median. And average, after about 3 months of increases, it dropped $3,000, sitting at $1,300,000.
And looking at days on market here, there's relatively no change here. So the average home, when it's priced well, priced to market here, it's taking roughly 12 days to sell. So I just kind of want to touch on this a little bit here, because the days on market is reflecting some buyer behavior as well. Good homes, guys, good homes are still selling quickly. The available inventory, while it has increased, the quality hasn't really been there with it either. The vast majority of good sellers are going to wait for a much better market to sell their property in, and they may also be forced to at this time. So having said that, just some boots on the ground stories here last week, out at some open houses, and still having to, in some instances, depending on how the properties are priced, still having to wait to get into the house, waiting for people to do their tours and get out. Very busy in some instances. Other areas completely flat. So it really depends on how you've priced your home. Even last week, we were involved in a multiple offer on a beautiful duplex with lots of nice upgrades, one block off of Commercial Street here. Nice property, good part of town, tons of interest. However, when you compare that to active listings that have not sold, the average there is 69 days. So that's quite a swing in terms of properties that are correctly priced versus those that are sitting on the market.
And that is your data for the week. So a little bit of some forward-looking ideas here. So what's going to happen next? Well, so much of this is driven by sentiment. And as we know, consumer sentiment is sitting at the lowest it's been since, of course, the depths of COVID and the global financial crisis. So as of right now, while there's a bit of stability creeping into the marketplace, it's stable at a higher rate, largely, of course, the mortgage rates. So stable is good, but high rates are not as good when we're talking about people being incentivized to come to the marketplace to be able to afford the homes they want. So this is really going to keep things slow volume-wise, but it also is keeping sellers off the sidelines as well. I mean, 2023 has essentially been the year of the freeze. Sellers can't get the price they want. Buyers can't find the home they want. Everybody just kind of sits and watches on the sidelines. Yes, the odd people that have to sell or want to sell or making a big move, yeah, they do. And we see some nice homes like Brian just touched on, hit the market and move quick. But overall, over 2.5 months of days on market for everybody who isn't selling, that's quite a long time. So where is it going to go? Well, slow. I think prices are going to continue to peel off a bit as these high rates continue to work themselves through the marketplace. Continue to see over like the next 3 months, sort of that 0.1 to 0.5% decrease in HPI over that time per month. And sales volumes will continue to be 25% below long-term averages. It's going to be a cold winter in that sense. Ryan, what's your take on what's going to happen next?
Yeah, no, I largely completely agree with what you just said. The other thing that I would mention, we're also recognizing this in the U.S. markets, right? And as the U.S. market just held their interest rates here, we saw the NASDAQ, for example, respond to that by jumping 1.6% just yesterday alone. The comments that Jerome Powell has come out and said. He's saying he would not rule out another rate hike at the Fed's next meeting in December. With that being said, though, and seeing the markets jump, largely Wall Street has kind of brushed that off as, that's something that they have to say to moderate and temper behavior. Because when you also look at U.S. Gross domestic product, in the third quarter alone, it expanded at 4.9% on an annualized rate. That's huge growth. That's very strong growth. When you consider, GDP in Canada, comparatively speaking, just going over in a little bit more detail here, August, the result was slightly lower. It was a 0.1% month over month rise. This was, and in July, it was actually revised down. It said that it was zero growth, but it's been revised down into negative contraction territory. And that was from Stats Can. So as we continue to sort of progress through here, it's possible that things might get, even though we're in technically, not technically, entering a recession here. And I think the hope is that it will be a shallow recession. The interesting notes here, if you look at the economist from Desjardins, he said whether or not the economy is already in a recession is less important than the fact that the lagged impacts of monetary policy are likely to materially depress economic activity moving forward. As a result, we expect the economy to be more clearly in a recession in 2024. So I don't think that really surprises too many people other than we're probably already in that cycle. So a lot of changes taking place right now. But keep an eye on GDP here. It'll be a big factor. Just it's becoming more and more of a factor, as much of one as maybe inflation and interest rates are going to be as well.
Yep, and still no sign of major inventory coming down the pipeline. You know, we've got the three levels of government trying, but ultimately they aren't aligned. So when you've got the Fed pushing through one set of rules, you've got your provincial level doing something else, and then down at the municipal, maybe they're doing things like tripling their DCCs, like we just heard come through. So, you know, one takes, one gives, and ultimately people are pulling back, and we're hearing some big rumors and some rumblings right now about a number of developers pulling back, and some maybe even going upside down here. So we're going to keep you updated on that. But either way, the other side of the recession, whenever that may be, the other side of rates, whenever they do decide to come down, it's going to be a tight market, and it's going to be a tight market for years. You know, we've got record immigration coming in. We've got targets increasing over the next 2 years while we're waiting for the rezoning to happen, but that won't even take place until 2026, essentially. And by then there could be a couple million more people here. So you can kind of see where this can go.
We haven't let, like, supply hasn't caught up, right? And that's supply hasn't caught up because this is a 20-year problem. And what we're seeing from, like you said, Dan, our municipal, provincial, and federal level governments are going to take years before their impacts are felt. So, it's still welcomed, but it's certainly late to the party.
There you go. That is our update for this week. Thanks as always for watching. If you want to talk about anything real estate related, we are here to chat with you. Just reach out to us at any of that contact information below. Thanks, and have a great day.